Well, it was the tax summit we had to have, at least the Gillard government had to have, as part of its post-election deal with independent MP Rob Oakeshott. So what was achieved apart from paying a political debt? I spoke to Professor Neil Warren from the Australian School of Taxation. Well, Neil, you've been attending tax forums and tax summits all your life. How do you think this one went?
Well, going into it, I felt that we were trying to sort of manage the expectations because, in a sense, the government had been brought to this by Oakeshott rather than something they wanted to come to it with themselves. But looking back on it, I feel very positive about it. I think there's some really good outcomes. The critical thing to remember is that this really is a forum for long-term consideration of tax issues. It's not really about short-term.
Well, there were a few short-term things announced, such as the increase or potential increase in the tax-free threshold, but that didn't actually come out of the forum, did it?
No, I mean, the government had already been in that space with the carbon tax increasing the threshold. So, in a way, there were some things that the government felt obliged to do as short-term measures, but really the things that are important in terms of what comes out of the forum are the long-term measures.
So what do you think were the best things to actually come out of the forum itself?
Well, I think there's a couple of really important ones. Chris Jordan's been asked to head up a business tax reform working group.
Chris Jordan being the head of the Board of Taxation.
The head of Board of Taxation, but this is separate, as I understand it, from the Board of Tax, and it will have a range of experts on it. In the first instance, they're to look at the carryback of losses issue and to report on that before the next budget, and so presumably there'll be something in the budget. But the really interesting thing that's on their terms of reference is to look at the allowance for corporate equity, changes in the way that we treat company income, the way we calculate it, the way we tax it. Now, that's really a very important development. Other countries are examining this and moved down that path.
But that was raised in the Henry Report. Did it get much further in the forum this week?
It did. A number of people raised it. I suppose in a way we're trying to work out what do you do with company tax in the long term. And there's various options that are there. Now, this is probably the most practical option out of the possibilities that were considered and that other countries are also considering, because you can't really step too much out of line of where other countries are going. And a number of countries have now investigated the allowance for corporate equity.
Could you explain what is meant by allowance for corporate equity?
The big concern has been with our company regime is that you allow a deduction for interest costs, so if you like, the cost of money used to fund your business from a bank, that's an allowable deduction. But interest, if you like, dividends that you pay to your shareholders to fund your business through shareholder capital is not a deduction. So what that does is creates a distortion between debt financing and equity financing of your business and encourages businesses to go more highly geared. And some have said that really that non-neutrality, that distortion, has in part led to the highly geared nature of companies, the exposure that they've had to the GFC and to interest rate increases.
Well, it's also helped the banks out, I guess, hasn't it?
That's right. In a sense, it balances it back up and makes more neutral how you fund. So, yes, it takes away some of that advantage that banks have got in terms of the attraction for a business to debt finance.
There was also a fair bit of discussion at the forum about state taxes. Did that get anywhere?
Well, that's the other second, really important and significant development. One thing that Treasurer Swan said at the outset is, look, states, don't come cap in hand. In a way, prove your stripes. Prove that you can actually address some of the issues that you've got with your state taxes, and then maybe after that we'll talk. So Andrew Fraser, Queensland Treasurer, and Mike Baird, New South Wales Treasurer, were quite vocal on the value of harmonisation, of addressing some of the issues with payroll tax and with some of the other taxes, and also getting rid of insurance duties. And so they were given the brief, and they accepted the brief to go away and to prepare a state tax reform plan to bring to COAG towards the end of next year. That's a significant development because it's really the first step in mounting significant state reform. And I think it's been terribly underestimated, the importance of that, because if the states can prove their stripes in seriously reforming their taxes, then I think the federal government and the federal treasury will take them a lot more seriously when it comes to the kind of options that they might want to take on in terms of, say, income-based sharing with the Commonwealth in return for further reform.
But the states have been richly compensated, haven't they?
That's right. I mean, if you look historically, if you go right back to the National Competition Council and the reward payments for microeconomic reform, you go back to the GST being introduced and significant overcompensation of most states. Yes, they've been compensated significantly. Now, the issue, in a way, is the federal government saying, look, these are actually different financial times. Revenue is fairly tight. So whatever you propose, you fund it yourself. And I suppose that's the sting in all of these recommendations. Everything has to be funded itself. So there's no big carrots, hanging out there for states or for businesses. However, that forces those states to be a bit more upfront, and honest with themselves about what they need to do and why they need to do it. And I'm confident that once they prove their stripes, the Commonwealth will come in and address some of those incentives, which actually comes to another critical issue, is that the GST distribution review that Brumby and Greiner are involved in at the present moment, they were given a brief to make sure that their review takes account of any possible disincentive effects the GST distribution might have for state tax reform. Very important complement to the states embarking on reform themselves.
But all this depends on the states actually proving their stripes, as you put it. Do you think that's remotely likely?
Well, history has proven to us that it's a real challenge for all states to agree. However, I think the states have now come to the position that they accept that they all won't agree, and that it is probably a bit naive to think that you can get all 8 of them to agree. I think if you get the major states, the Queenslands, the Western Australias and New South Wales, Victorias, to agree, you're going to get a long way, because they set the example, and then businesses and others are going to say, well, look, lesser states, just align your bases, just harmonise with those other major states. So get the leaders to set the pace, get them to be the game changers, and then the other states will fall into place. But I think it's reasonable to think that you won't get them all to fall over in excitement for it. But if you get the main ones, that's what's important.
Thanks very much, Neil.
Thanks, Alan.